Everywhere you look right now, people are talking about stablecoins. Not in the way they used to, not as background infrastructure, not as something only crypto native people cared about, but politically. In the United States, stablecoins are suddenly showing up in hearings, in draft legislation, and in serious conversations around regulation, especially tied to bills like the Clarity Act. In the UK, regulators are openly discussing limits, caps, and guardrails. And globally, central banks are quietly, and sometimes not quietly, flagging concerns about what happens when digital money starts behaving differently to the money they're used to controlling. And that alone should make you pause. Because this conversation didn't start because stablecoins suddenly failed. It didn't start because they collapsed. And it didn't start because of a market crash. It started because stablecoins worked. They became useful, they scaled, and then they began to evolve. And the moment they started evolving beyond boring digital cash, they crossed an invisible line. Not a technical line, a power line. And once you understand where that line is and why yield sits right at the centre of it, a lot of what's happening right now starts to make much more sense. Before we go any further though, if you're new here, welcome. My name's Paula, and on this channel we talk about crypto and markets in a grounded, realistic way. No hype, no price predictions, and no pretending this space is simple or risk-free. The goal here is understanding, because when you understand what's happening underneath the market, you stop being whiplashed by every headline. And if you appreciate a deeper understanding of topics like this, I co-host a weekly podcast called the UK Crypto Podcast with Milkshake Matty. It's a much more conversational format where we connect these dots slowly and properly. I'll link the latest episode at the end of this video. You can also access it on Spotify. So if this kind of discussion is your thing, make sure you check that out. Now, let's talk about why stablecoins are suddenly such a big deal. For a long time, stablecoins were treated as plumbing. They were digital representations of existing money, a bridge between crypto markets and traditional finance, a way to move value faster, cheaper, and more efficiently than legacy rails. And as long as they stayed in that lane, regulators tolerated them. They didn't love them, they didn't fully trust them, but they also didn't see them as an immediate threat. Why? Because a stablecoin that just sits in a wallet doesn't really do anything. It doesn't compete with banks. It doesn't change how credit is created. It doesn't interfere with interest rate policy. It's passive. But the moment you add yield, stablecoins stop being passive. They stop behaving like cash, and they start behaving like bank deposits. And this is where the shift happens. In the traditional financial system, your bank deposit isn't just your money sitting safely somewhere. It's raw material. Banks use deposits to lend. They transform short-term liabilities into long-term assets. That's how mortgages exist. That's how business loans exist. That's how the economy is lubricated. And in exchange, you get convenience and a small amount of interest. Often, a very small amount. Now imagine a parallel system emerges. And in that system, you can hold a digital dollar that moves instantly, works globally, settles 24/7, and doesn't rely on a single bank. And now imagine that same dollar can earn yield, not through a savings account, but through on-chain mechanisms, tokenized instruments, or automated money markets. From the user's perspective, that feels like progress. From the system's perspective, it feels like disintermediation. Because if enough people move their money out of bank deposits and into yield-earning stablecoins, banks don't just lose customers, they lose funding. And when banks lose funding, lending tightens, credit becomes more expensive, economic activity slows. This is why the conversation escalates so quickly once yield enters the picture. And this is where an important distinction matters. You'll often hear this framed as governments are scared of stablecoins, but the reality is much more layered than that. The first institutions to feel uncomfortable weren't politicians, they were central banks. Central banks don't care about crypto culture, they don't care about decentralization narratives. They don't care when something is on-chain or off-chain in an ideological sense. What they care about is how money behaves. Central banks influence economies indirectly. They adjust interest rates, set reserve requirements, and manage liquidity. But all of that assumes that money flows through a banking system they can observe, model, and stress test. Yield-bearing stablecoins weaken that assumption. When money sits outside the banking system, earning yield through mechanisms that don't rely on bank balance sheets, interest rate changes don't transmit as cleanly. Policy becomes less precise, control becomes softer. That's not theoretical. That's why you see central banks consistently pushing for payments-only stablecoins, restrictions on user-paid interest or rewards, and in some cases, central bank digital currencies as a counterweight. But central banks don't write laws, governments do. And once central banks start raising red flags, that concern flows upward into treasuries, finance ministries, and eventually into legislation. And that's where something like the Clarity Act fits into this story. The Clarity Act isn't about banning crypto, and it isn't really about protecting retail traders either. It's governments responding to signals coming from the monetary layer, trying to draw legal boundaries before stablecoins and on-chain yield products become large enough to create blind spots in the financial system. It's an attempt to define what stablecoins are allowed to be, who is allowed to issue them, and what they are not allowed to turn into. And crucially, it's happening now, not because something has already broken, but because policymakers are trying to avoid waking up one day and realising they've lost leverage over the system. This is where the US conversation gets loud, because the US financial system is enormous, deeply interconnected, and heavily dependent on banks as intermediaries. Any serious shift in where deposits live has implications not just for crypto, but for credit markets, housing, and government debt. But this isn't just a US issue. If you look at the UK, you can see the same concern expressed in a different tone. UK regulators have openly discussed limiting how much stablecoin exposure individuals can have, particularly in retail contexts. Not because stablecoins are inherently dangerous, but because scale changes everything. Small amounts don't matter. Large amounts do. If households start holding significant value in digital pounds, digital dollars, or foreign currency stablecoins, especially if yield is involved, that changes how money circulates through the economy. So instead of bans, you get caps. Instead of prohibition, you get guardrails. Different tools, same underlying concern. And then there's China. China saw this entire trajectory early and chose a very different response. Private stablecoins? Banned. Open DeFi? Banned. On-chain yield outside of state control? Shut down. And instead, China rolled out its own solution, the digital yuan, a state-issued digital currency with no yield, fully visible, and completely programmable. From the outside, people say China banned crypto, but that's not quite right. China banned private monetary systems and kept the technology for itself. That wasn't being anti-innovation. It was being very clear about who controls money. The West isn't going to copy China's approach, but it is responding to the same structural issue. Stablecoins are tolerated as payment infrastructure. They become controversial the moment they start competing with banks, money markets, or sovereign funding channels. And that is why the tone has shifted. This isn't about stopping innovation. It's about containing it. Keeping stablecoins boring, keeping yield gated, keeping capital within the sight of the system. And here's the part that most people don't like to hear. This isn't really about crypto at all. It's about who gets to create yield, who gets to distribute it, and who loses influence when money stops flowing through traditional pipes. Financial control doesn't usually disappear overnight. It erodes quietly, through convenience, through efficiency, through better alternatives that feel harmless at first. That's why policymakers don't wait for collapse. They act when behaviour starts to change. Which brings us to the obvious next question. If yield on stablecoins gets restricted, if earnings returns directly on digital cash becomes harder, where does yield go instead? That question isn't hypothetical. It's already being answered, just not in the places most people are watching. And that is exactly what we'll unpack in the next video. Before you go, if this breakdown helped you see the bigger picture, let me know. Hit like if it added value, subscribe if you want more content like this, and drop a comment below. Do you think these restrictions are about stability or about control? And don't forget, if you want to go deeper on these conversations every week, join me and Milkshake Matty on the UK Crypto Podcast. Thank you so much for watching, and I'll see you in the next one.